Good morning, everybody. Welcome to the Lock in Your Success Options Trading for Income weekly update for October 6th, 2014. Before we get going, we would like to remind you that the presentation is for educational purposes only. We're not broker-dealers or financial advisors. We're not making any specific trade recommendations. Also, please note that the trades and results presented here are hypothetical computer-simulated trades. And also keep in mind that the risk of loss in trading options can be substantial, so please be aware of all your risks prior to placing any trades. Before we get going, I'd like to encourage you, if you're watching us on YouTube or some other venue, come on over to our website, check out our programs, M3, Bearish Butterfly, ROCK, and M21, as well as our group coaching and trading triangle programs. And join our mailing list, get your free reports, 7 secrets to becoming a successful trader. Sign up for the free weekly webinar. Okay. I'm going to start out this week by just kind of letting you guys know that I'm a little bit disorganized. I was at a seminar left Friday morning and got back at, I don't know, very late last night. So a little bit short on time getting stuff together. So we're just going to do this the best that we possibly can. So we will take a look at the markets first. So if I come here, I remember last week I was kind of saying that there was no reason that the Russell wasn't going to touch 1080, and that's pretty much what we got. So, and of course, once we got to 1080, I was expecting some sort of a bounce. The reason I was expecting that has more to do with the SPX than anything else. We had a short-term support break on the SPX, this area here, coming into the week last week. And it made sense that the SPX was going to test its more primary support area down here at around 1950, which it did. And that would obviously bring the Russell down into the 1080 level, especially with it being a little bit weaker than normal. So as of Thursday, if you were paying attention, you should have saw this nice reversal candle. If you do any kind of technical analysis or candlestick analysis, this is a bottoming tail hammer, or some people call it, but it's basically a bullish reversal pattern at a support level, so the bounce on Friday shouldn't have been too much of a surprise for anybody. And we got that not only in the SPX, we also got that on the NDX, and we got it on the Dow as well. So fairly predictable moves that far. Now, as far as where we go from here, the weakness in the Russell on Friday was a little bit surprising. I would have expected actually a stronger bounce. You had a big gap, a little bit of intraday back and forth, just kind of sat there for the day. So we still, as of right now, are still under our primary resistance level, which is going to be sitting into this range here. If we break up over this and get back up into range, we'll probably have a move up into this red trend line area here. If we don't do that, then we'll have to watch this for a further breakdown from here. As of right now, I wouldn't expect a further breakdown. I'd kind of expect us to hold a relatively sideways range, albeit a little bit lower than it was before. Most likely, we'll probably, if we did a trend line here, we'll probably run into either the bottom of this trend line or into this trend line here, and then reverse back down to the 1080 area. Would be my best guess coming forward. That could be canceled depending on what the other indices do, but as far as looking at the Russell by itself, I would say either we reverse here, retest the lows, and come up to this trend line, or if everything breaks higher, then if we break over this level, we're probably going to test this red trend line and then come back down into this area here at 110. So that would be my most likely market moves going forward. A little bit indecisive right now because we're at a decision point. Like I said, last week was pretty predictable, and it followed pretty much what we thought it was going to do. So that said, if we come into the positions that we have, we had 2 October trades still on. If you remember, we were already out of the M3, already out of the Bearish Butterfly. We're still in the ROCK trade because that was kind of just started. And we're still in the V Condor because we usually bring that to expiration, although I'll talk about the V Condor in a minute and why we may want to pull out of that early. All right, so as far as the ROCK trade, there were no adjustments on Monday. This was the position we were sitting in here. If we go to Tuesday, we had a significant pull down on Tuesday. And this was rolled back let's see. We rolled, essentially, if you're doing this in the course structure, and you're looking at butterflies with verticals in them, we rolled back from where we were before, which I believe was, actually, let me look at that. Right, we had the butterflies positioned up here at 1100. With the move down on Tuesday, we actually came down under 1100, I believe. No, not quite. We're about 1107. But we were, prior to adjustment time, we would have been positive delta at one point here during the day of almost 100, right? So we're positive 94. And a lot of times we'll let a ROCK trade go to 100 delta. We'll usually pull back a straight M3 trade at plus 50. Realistically, this was over 100 intraday, and towards the end of the day, it was still up towards the 90s. So we went ahead and rolled this back, and we just rolled it back to 1080, I believe. Right, and rolled it back to 1080, and we put, so this is similar to a set of 1080 butterflies with 10, 1080, 1100 verticals. We still are slightly positive delta, and that gives us a position that looks like this. So really nice looking M3 type of a position here still. And on Wednesday, we got a further down move of another 16 points. So we rolled this all the way back essentially to 1060, which was another 20 points. And we had, like I said, if you're emulating this with call verticals, you'd have 10, 1060, 1080 call verticals. And we still maintained the call at 1060 here. And this is what the position looked like coming into Thursday. So essentially we're just resetting the position as the market goes down. And then, of course, we had the bounce, and we made a small adjustment on Friday, which is just 5, 10, 80, 1090 verticals, which you'll see in a moment. And this is where we went in, coming in, closing Friday. So this is our current position, and this is this is what we look like here. So we're slightly outside the 10. I did the 5 verticals at a lower delta number because we were outside the 10. And looking at the T-log, we'll do a whole T-log look here. You can see pull down on the 1st, and the rollback on the 30th, and the 5 verticals on the 3rd. All right. So that is where we sit as of Friday close. So going forward here, we're simply going to continue to add verticals as needed to control our delta in Vega. If we, what we call outrun the position and get up over, here, see, it would be 1120, then we'd be looking at the possibility of going into a ROCK trade structure to for the remainder of the trade, depending on what the conditions are at the time. That's what we get going on for the ROCK trade. So everything's going fine. You can see this here, we're 14 days to expiration. We still have our nice flat T+0 line, which is, you can keep this very, very flat and stable right into expiration. So nice trade going so far. And let's see. We have the Condor trade that has had no adjustments for the longest time. Except for buying back one of the calls when the market was up, and we're sitting here at about 1,000, 1,200 profit on Friday. This is what our position looks like here. So we have an adjustment point that's probably not going to get hit down until under 1080. Oh, I know it's not at least going to be that because we were already there and it didn't hit any delta numbers. And if the market continues to bounce, we'll start taking this V out to start flattening things out. So that's, oh yeah, and I was going to talk about this a little bit. So one of the things that's going on, if we look at the November V trade, I'm always looking at these trades together. I'm saying, what's the October one doing versus the November one? And I said that I don't like to be in the same strikes. The market has put us in close to the same strikes for the last couple of months because it's been so sideways. And that being the case, we're in one of those situations where we're particularly vulnerable here on this trade, because we're in 2 months. If the market really decides to crash down, then it may be an issue for us. Because when we look at the November one, you'll see the November one's suffering a bit. So that being the case, that would cause me to pull out of this trade early. If we get especially if we get some sort of a support break at this 1080 level, that's somewhat significant. I don't want to take maximum loss in both months, and there's a good chance I'll take maximum loss in November. That being the case, this one will be closed probably at close to break even or a slight profit. As of right now, we're planning on staying it open, but because of that, then I'm considering leaving that. All right, so that is the October V Condor, and that's what it looks like. Moving on to the November V Condor. All right, so the maximum loss in the V trade here is going to be $5,000. It normally makes 3. It sometimes makes as much as $8,000. It's a $50,000 planned capital position. So we're talking a 10% maximum loss. A normal gain for this trade is going to be, like I said, around $3,000, which I believe is like 7 or 8%. And on a good month, you can pull sometimes almost 10,000, which is 20%. Because if you get up into the V, like if this month here on the October trade, if we just kind of grind down, we had a mild support break and it wasn't anything too bad, and you wanted to hold a position, you could get up into the. If we switch to October, if you can get up into here, you can make some real money with this sometimes. But usually when you make the money is on a grinding up move. When it's grinding up enough where you don't really have to buy back many shorts and you kind of get up into this area here, a lot of times you can pull some really decent money out of this. On an upgrinding market. We had that happen a couple times in 2013 when the market was just grinding and grinding. So that is, that's when that makes more money. On average, that's basically how the numbers work out. So as far as November goes, this is what we look like now. I had to buy back one of these shorts on, what day was it? It was on the 1st to control our delta. We get our positive delta number. It's down about $2,200. Position looks like this if we zoom it out. V is sagged quite a bit, so if we come back up into here, we'll have to do some things to get this higher, and essentially that's selling off the straddle and see how it goes. Realistically, if it does come up into this range and we do sell that off this late in the trade, very, very good possibility of actually having a decent month. If the market just crashes from here, then we'll just be fighting it, and it may or may not max loss out. We'll have to see. Depends on what it does. Usually if it's a severe crash, it'll actually make money on a position like this. If it's kind of just a grinding down movement that's just too fast for us in the buying back stages, a lot of times we'll take some sort of a loss. Usually not too bad. All right, so just a question. What's the mechanism for flattening the V condor? Yeah, just closing the semi-straddle, or either close it, or you can go out from a straddle to a strangle. So in other words, instead of having both my shorts at 1140, I can put some at maybe 1080 and, I don't know, 1180. Right, so I can just widen those out. So that would be the mechanism for flattening that out. You know, as the market comes down and volatility increases, we're just going to buy back these shorts. It'll flatten the T+0 line out. And sometimes, depending on the conditions, you won't hit the maximum loss to the downside. You'll end up just maybe closing the trade at some sort of a loss. A lot of times not maximum loss. It's kind of rare to actually hit maximum loss numbers. All right, so that is an S&P Condor. And that is all we have for October. This is the first November position. We also have for November a Bearish Butterfly, which nothing happened to. The Bearish Butterfly kind of loves this type of conditions, especially early on in the trade. So coming over to November Bearish Butterfly, we're sitting here at the 1090 shorts. We've had no adjustments since this has started, and this is what the position looks like here. So all is good. If we get a strong enough bounce, we may end up scaling in or having some sort of a delta theta ratio issue where we can roll this forward. But as of right now, everything looks really good. And the November M3 trade did have a rollback. And earlier in the week, we were, let's see, Let's come back to Monday. Monday we were here in the 1090 short strikes. Let's see if we can find the call here up at 1050. And this is what our position looked like here. A lot of the live trades we had, we actually went in heavy butterflies. So, like I went in 15 to 1 on the butterflies on the live trade that I have. And the down move was actually beneficial to this. It actually put it up a really decent amount of money. And that's because we were a little bit positive delta going in, which is fine. But this was actually leaning a little bit bullish. So that's why it didn't get any kind of much of a profit and loss pop here when the market came down. But this is what we have coming into Monday. And on Wednesday, we exceeded, if you're coming to Wednesday here, before our adjustment. One of the things that happens sometimes, especially when the volatility is really high and you're in butterflies, you can get down under your short strikes, like this is 1090. We never actually hit a delta point where we should be rolling this back. However, there's also secondary fail-safes in the system to help protect against a downward crash. And that's essentially to roll this back when we've exceeded the short strikes, regardless of the delta. So here we came in and we just did a rollback 20 points down to 1070. If we take a look at our T-log, it was down on the first. Actually, we didn't roll it back yet. All right, so here we are down at 1070, and with the reversal, we basically managed to just kind of hold all set. So if we come into Friday, we're sitting here at minus 11 delta, slightly underwater, pretty much break even. Theta and Vega are good, and here is the current position right here. So that's pretty much what we have on for trades. So everything is going fine. I expect, like I said, the market to either push higher or maybe hit a double bottom at the 1080 area and then continue higher. So generally bullish for the week, not terribly bullish. It's bullish for the week, sideways longer term, right? In the markets, I do think we're kind of pulling into some sort of a sideways range at this point. All right, so just going back to the mechanism for flattening the V condor, because I didn't read the whole question. Yeah, so as far as flattening the V condor or straightening out delta, with the V condor, we're buying back shorts to correct delta problems, and if we have if we're in the center, we are either going out from a straddle to a strangle, or we're going to just completely remove the straddle altogether to deal with the sag in the middle. Okay, or if we go negative delta in the middle. All right, so I mentioned in the past I have a favorite setup for a near expiration trade that is 2 butterflies 20 points apart, or 40 points apart if we're around 10 days to expiration. Right, so actually close to expiration, realistically, the most efficient trade close to expiration is a condor. So I like to do condor-ish type of trades. So I probably wouldn't necessarily go into a butterfly. I could do a 40-point a 40-point apart butterfly, which is basically going to be, is essentially going to be a condor. It's probably more contracts than you have to have. I mean, they're fine. Close to expiration. Oh yeah, you know, I may have said that in the context of a ROCK trade. So yeah, so if I'm close to expiration with a ROCK trade, yeah, okay. So if I'm close to, my memory's coming back now. If I'm close to expiration with a ROCK trade, and I'm maybe going from an M3 into a ROCK trade, or if I happen to enter a ROCK trade 15 days to expiration or something like that, then yeah, a lot of times I'll put the price in the center. I'll do a entry with 2 butterflies 40 points apart, and I will basically trade it to ROCK guidelines. So if the market goes down, we can go into a cat position, or we can, if I want to, I can go into an M3R position. For those of you who don't have a ROCK program, you probably don't know what I'm talking about, but it's a little too complicated to explain here. And then if the market goes up, I'll just continue more or less with the ROCK guidelines to the upside. All right, so can I talk about my upcoming programs? So Trading Triangle program is already here, and the program is actually full. That's a one-on-one coaching program. Talks about trading psychology, the trading business, and the trading in general. So it's a very, very comprehensive program that is basically designed to get somebody into full-time trading if that's where they'd like to go. So that's a very comprehensive program. I can only take a few people at a time, and right now the program is currently full. As far as Trading Triangle coming up, I am working on an online program so that we can do and deal with more people. Because right now it's very intensive one-on-one coaching time. If I can pull a lot of the one-on-one coaching time off of the program and put it in some sort of a print program, which is what I'm working on, then we can get more people through the program. But right now it's only, like I said, a few people at a time. That's a big commitment on my end. All right, so as far as SSS, super simple spread trades, that program is temporarily put off to the side, and we've been talking with the guys at SMB. I have one more program that I'm committed to doing with them. We may end up doing more, but I have decided to push into the advanced M3 program as an alternative to that. And if you want to know more or get an idea of what that might entail, take a look at the group mentoring session that we have available to the public, because we're doing an open house for group mentoring in October. So they're available to the public. We had one on Tuesday. We talked about a little bit about what a more advanced position management might look like. And I put it into the chat. Ray graciously gave me the web link for that. I know I should know it, but I didn't. And he gave me the web link for that. I put it into the chat, and you go ahead and watch that. That'll give you an idea what the advanced M3 program is going to look like when it comes out. So that's the other program that's coming out. And as far as other stuff, like I said, I'm probably going to come out with a super simple spread trade strategy. It may be on my own. What I didn't want to do with the programs in SMB is I didn't want to go from something that's advanced to something that's very, very basic. I wanted to stay up in the level and give somebody, give you guys what you really need to know to become even more advanced. And advanced M3 or advanced position management is going to be very helpful to those people who are trading the M21. They're switching back and forth from a M3 trade to a ROCK trade to a Bearish Butterfly, and making these adjustments. And when you do that program, it's going to be a whole lot easier to make those adjustments more efficiently, more effectively, and also pulling out of the butterfly structure and not actually having butterfly structures anymore. So that's going to be a really cool program. Okay, so those are those two programs. I have some other stuff coming in the works too, but that's essentially what you asked about. So that's what we have. Given the current market conditions, what type of entry would be better suited for November expiration cycle? I mean, like I said, right now, pretty much if you go into a ROCK trade, you're going to get kicked into almost guaranteed an M3 trade. If you're doing an M21 trade, you're going to do your market analysis and find that you have such an upside potential that nothing really makes sense except for an M3 trade to start with, although you can pick your points to get more aggressive in the market, which we do have some points that we could do that actually this month, which would be good. But essentially, M3 entries is what I like for November expiration cycle. As long as the market's unpredictable, then that's generally what I'm going to pick. When it gets really predictable again, then we can go into some other things and really take advantage of the market. What's a good position if you're looking for a quick volatility drop? Usually, like an unhedged M3 position is a good position as long as the market doesn't move too fast. So an unhedged M3 If you are familiar with what those are, then that would be a good position. Again, that unhedged M3 will be covered in advanced M3. And is it normal for the M3 trade for the T+0 line to be below the 0 line early in the trade? No. Usually, for the M3, when you enter, you have a relatively flat T+0 line. It shouldn't be significantly low on trade entry or early in the trade, generally. All right. So what is the latest data entry for a bearish butterfly or M3? So the latest DTE for a bearish butterfly, I would probably do would be at the very latest 35 days, and I only do it that late if the market was up significantly from when you would have entered anyway. Actually, I would take a look at what the market would look like if you entered it at the right time. If the position would be significantly drawn down, I'd probably enter it maybe even as late as 30 days to expiration. After that, I'd probably go to the month out afterwards. But the latest I would probably enter would be 30 days expiration. And then again, that's if the market, if I analyze it in the market was significant, then the trade would have been significantly down money from what I would have put it on. If the trade would have been up money from what I put it on, I would not. I would just scrap it. Maybe 45 days in general is my most comfortable time. So 56 days is fine. 45 days is probably fine, even if the 56-day trade would have been up. After that, I'd go 35 days if the 56-day trade would have been down money. If the 56-day day trade would have been down a significant amount of money, then I might go to 30. But after that, I'd probably skip to the next month. Can I give you some examples of how to keep your margin as low as possible trading in M3? Again, that's going to be advanced M3 material. Essentially, you're going to do it by keeping your long strikes closer to your short strikes. So in other words, you won't be in a actual butterfly anymore. So you might have your long wing to the downside. It's usually 50 points. It might only be 30 points, right? So you can take an M3. You can actually trade it pretty much double sized and double your profits in an M3. Bring your margin down because you could really trade at twice the size, which is really cool once you get into, again, more advanced M3 topics. And to actually show you how to do that, it would take more time than we have here. But that's where you'd find that coming up in that. And also we go over stuff like that in group mentoring. Is this webinar recorded? Yes, it will be recorded. It will be posted on my website in the blog. Okay, being the M3 is negative Vega trade, you prefer to start it on a down day. You know, realistically, you're going to get an increase in the butterfly cost on a down day, even though the butterfly is negative Vega, but you're going to get a really, really good call price. So when you flip it around and you do it on an up day, sometimes you'll get a really good price on the butterfly. Sometimes you won't, because when the market shoots up, sometimes if it's not an aggressive move up, you'll get an increase. In other words, sometimes the value of the butterfly on an up day will remain stable instead of dropping. Usually when you get a hard up day, you'll get a very good drop in the butterfly prices, and you can put a call on. The call is going to be expensive, but you're going to get a really good deal on the butterflies. Usually on a hard down day, you're going to pay a little bit too much for the butterflies, but you get a really good deal on the calls. There's a spot in the middle there where you get a day when the butterflies are priced more than normal, or the market price goes up and the butterfly price goes up and the call price goes up. Those are the worst days to buy. So watch out for that. So that would be the worst time to buy, and the best time to buy is either on a very, very hard up day or a general down day is usually pretty good too. So yeah, so right, so like when you get like the M3 class, we start with a butterfly, vertical spreads, and a call. And that's pretty much how we trade it throughout the trade, and that's the way a beginner would do it. And the course is put together that way because it makes it understandable from somebody coming through a condor trading environment, or from pretty much any other program out there. So if you're going through, I don't know, you know what the other programs are. The other income programs are the butterflies, condors, variations of such things, and diagonals or whatever. But to keep it understandable, we keep it in that butterfly vertical call position. Eventually you get into this area where you just place options all over the place to produce a T+0 line profile that you want. So yeah, if I want lower margin, there are some side effects to having lower margin. They're minor. But if I want lower margin, then yeah, I'm going to be in something that is not really a butterfly or not necessarily even a condor anymore. It's just going to be a kind of a complex options position. And the key is learning how to manage the complex options position. So that's the answer to that question. And would it be possible to review the last webinar with SMB, which I'm assuming you're talking about the group mentoring session with SMB? Is that what you're talking about? Yeah, right. So I put the link in the chat. So does everybody see the link in the chat that I poked in there? Or does anybody see it, I guess? Okay, great. All right, yeah, so it's in there. Just follow that link. That's where it is, and you can go there. All right, so I can post, when I post the video, I can post the link with it. Let's see. Or I'll put it in again. Let's see right now. I could probably post it with that. So I'm sending it to everybody, and the link should see the link now. So you go ahead and watch that. That kind of goes over that. We're having another free group mentoring session, not this Thursday, but next Thursday that everybody can join in. And it's going to be a little bit more basic than the other one. But that'll kind of give you an overview of the advanced M3. And like I said, super simple stuff is going to be coming out at some point. I'm not sure if it's going to be done directly just through me or SMB. It's going to be a fairly low-priced program. It's more for beginners and that type of stuff. So that's all I have for the week. Yeah, Derek, I've been talking with Seth about that. His question is, am I coming out with an advanced M3 program? And yes, I've been talking with Seth about that would probably be a better fit than super simple spread strategies. So that is the direction we're going to now, and I'm working on putting that together. All right, so I believe that's all the questions, and we've been on for 35 minutes. So everybody have an awesome time, and we'll see you next week.